Okay, so I'm sorry for those that did not manage to attend today's lecture. We covered 1 hour without recording, but now we are recording a lecture. All right. So for those who are unable to attend, try to reach out to your classmates so that attend for that 1 hour missing discussion. But let's continue. So convexity. So we are just talking about the various approaches to optimizing a portfolio. We've covered 3 or 4 of them. Now we're talking about experience base and the convexity. So in terms of convexity is basically your second derivation of the bond, meaning what? In a bond yield, what happens is that let's say you have your bond yield curve, your duration is your line, right? The convexity is how much your increase or change in interest rate, change in bond yield based on interest rate will change as more and more of your interest rate increase, right? So as your interest rate keep on increasing, let's just say your interest rate keep on increasing, to what extent would your bond price increase? So the idea is like maybe at the start is a one-to-one, right? One-to-one increase. So if you increase your interest rate by 1%, maybe your bond price increase by 1%, hypothetically. Now, the thing is, if your interest rate increase by 2%, maybe it start to increase by 2.2%. So it increase a bit more. So if it increase, the interest rate increase by 3%, maybe it'll increase, your bond price will increase by 3.5%. So there is a upwards increase in your interest rate. And so that's the idea of convexity. How much more will the bond price increase over time? Okay, so this is such side digression on bond, as I think some of you are quite interested in it. But now let's go back to experience base. So if your client is a bit younger, a young client would have a longer time horizon, so meaning you can invest more in stocks simply because they have a longer period to hold the asset, right? So the longer you can hold the asset, meaning you can take on more risk. And generally, as you get older, you want to reduce your exposure to equity. Okay, so I think now is the perfect time to just take a break. As usual, we know you do 2 breaks. Let's maybe come back in seven. Sorry, in 7 minutes time, meaning around things 8:20. Shall we come at 8:20? We'll pause here for a while. If you have any questions, feel free to put it in a group chat. Yeah, we can come back. All right, welcome back. We have a quick short break. Um, any questions on the lecture so far? Any comments? Need to repeat any parts of the discussion we had so far? So, I just want to repeat a small portion of the bond yield. I think it wasn't so clear. Recall that I mentioned the inversion of the yield curve, right? So this is the maturity, and this is the yield, right? So what's happening here? So as you buy a bond with longer maturity, the yield decreases, right? And this is very funny because remember what we talk about, the longer this is the normal curve, the longer the the maturity of the bond you buy, the more returns you get, right? You. So y to mature you to maturity. So this is a normal case, and this is the inversion case, which is what we say signaling a recession is coming. And the reason why, so I think this part I didn't really explain properly. The reason why your yield decrease as you buy a longer bond in the case of an inversion is this, because you have a high demand for long yield bonds, right? When there's high demand, the cost goes down, right? So your yield actually decreases. And you can, therefore, it signifies that people are actually buying longer duration because expect the current market situation to be bad. That's why they want to buy long into the future. And therefore, we see an inversion like this. Okay, this is just a small comment I like to highlight again on this bond. All right, so some of these slides, so we are still in the topic of strategic asset allocation. So some of these slides seems a little repetitive. Um, yeah, they are like this. Okay, so again, we talk about strategic asset allocation. I will not go through all the line by line. Basically, is what we have already talked about. So this is written in, I guess, a bit more nicely. So SAA reflects the best mix of assets, allocation based on various parameters, whether is it conservative, is it more aggressive. Remember, everything is based on the IPS. I think I mentioned here, the IPS. So what is your investors' return objective? What is their constraint? So we really fall back onto the first lecture that we talked about the IPS. And that's how we create our strategic asset allocation, right? And we already talked about almost 4 methods of how we allocate assets. So we control the systematic risk, and then of course we do some review of your asset as time goes on. So this is just a repeat. I will not talk about this. We already discussed all these details here. So I'm just going to skip. Now, we have example here on the Indigo Fund, which is a Swedish foundation currently investing in equities and government bonds. The portfolio Sharpe ratio is 0.4. Anyone recall what is the meaning of Sharpe ratio? What does it represent? What does the Sharpe ratio represents in general case? The risk and return, perfect. Thank you so much. That's the risk and return ratio. The fund is considering adding real estate in the portfolio. The real estate has another Sharpe ratio of 0.12. Predicted correlation with an existing portfolio is 0.35. right? So based on this information, determine whether the fund should include the US real estate in its portfolio. So we are given this information. We have existing portfolio. So let's determine if we add the real estate into the portfolio, what is our Sharpe ratio, right? So our existing portfolio Sharpe ratio is 0.4. We have a correlation of 0.35. Okay, so with the US real estate into our portfolio, our Sharpe ratio will be 0.14, right? However, we see that our Sharpe ratio for the real estate is 0.12. So it's actually lesser than what we should be required to obtain if we add in real estate in our portfolio, right? So the thing is, because of that, we should not add this particular real estate with a Sharpe ratio of 0.12. So the idea is that we need to find another portfolio of real estate that would give us a Sharpe ratio of at least 0.14. Then we'll add it into our portfolio because this is the minimum that we should accept based on the calculation of the correlation. Okay. Now we have another example here. So this is using your mean variance frontier again. And this is quite an interesting example. Okay, so we have a client, Ian, who has we prepared IPS for him. He indicated that a annual real, okay, here's real return objective of 3%. And capacity accept a standard deviation of 15% or less. He has a net worth of 2.75 million, which comprise of 240K pounds in house and the rest and a balance in cash. He plans to make a 150K gift to his favorite charity in 6 months. So it's in 6 months, not now. It is important. And fund the gift using cash. So he's going to use his cash to pay. You have estimated inflation is 2.5%. Basis point, the returns is 40 basis point. Risk aversion, remember we did the whole calculation on utility. So he has a risk aversion factor of 3. Okay. To the extent he undertakes additional real estate. Okay, so the question is to the extent he undertakes additional real estate. So the question is, okay, you want to undertake more real estate, right? He will include whatever that he has as his house, which is 240K as part of his total real estate allocation. So now the question is, how much should he allocate in real estate, right? Risk-free is given at 2% here. Okay, so the question is how much should he allocate to real estate? So let's look at what he's working with. He has the various 6 asset classes. He has 8 corner portfolios provided. Now, the first step in any mean variance frontier example is to first calculate what is his return objective, right? So his return objective is given by 6%. As we can see here, we added the returns required, his investment returns, and the return of 2.5%. Okay, so at 6%, so it's very similar. At 6%, let's look at which portfolio should he include. Now, we can see that at 6%, he should look at portfolio 5 and 6, right? 5 and 6 here. Okay, so a proportion of 5, proportion of 6. Okay, so let's use the same method. We let 5, in this case, let 5 be W, 6, portfolio 6 be 1 minus W. We find what's the weight required. Okay, we multiply the weight by the various assets. So this is what we have covered in the 2 examples already. Same method, we just multiply. Okay, now, because the question is not so simple as, okay, just find what is his allocation to asset, right? We need to also calculate what is his standard deviation because we're given the utility of the person, right? His utility function, and utility function requires the standard deviation of the portfolio. So we can calculate what's the expected utility. So how we calculate the standard deviation? We just take the proportion in portfolio A, proportion in portfolio B, right? Given by what we calculate in W. W is 0.36, and then the 1 minus W is 0.64. And that's how we can get the standard deviation here. Now, I'm going to pause here for a while. And I think some of y'all did email me about the standard deviation formula. Now, for portfolios, I have a question for everyone. How come I did not consider the correlation here, CORR/covariance? Anyone know? So the question is, in this calculation of portfolio standard deviation, how come I did not consider correlation or covariance? Anyone want to give a try? It's okay if it's not correct. Mm, okay. Diversified. Not really. Okay. Maybe one more person would like give a try. Why I just take just the ratio of the standard deviation, right? Um, and everyone knows what is the standard, so-called the portfolio standard deviation formula I'm talking about, right? The one with the square root of weight square times variance plus weight square times variance plus 2 times weight times correlation times standard deviation, right? Everyone knows that one, right? What I'm talking about. Okay, so the reason why is both portfolios have the same asset composition. Okay, so I repeat again, the reason why is that both portfolio has the same asset composition, and because they have the same asset composition, the correlation doesn't change, right? The correlation, I'm just adding the different assets together, like the percentage of assets together. I'm not changing the asset. I'm not adding the 7 asset or number 8 asset, right? When we add additional asset, that is where we need to consider correlation. We need to think about all this, right? Can you see here? We are actually adding this. The correlation is 1 because we are doing the diagonal of the correlation matrix. So this is very important because the question, right, can twist, like in your finals, right? They can twist the question. They say, now I want to add a 7 asset, the number 7 asset. When they say add another 7 asset, you now need to consider correlation already. Okay? Then we need to, that's why they give you information here. So actually, if they say I want to add 7 asset, you have enough information to actually calculate the standard deviation of the new portfolio because they have given you the correlation. Let's say if they give you number 7, they give you some number here, you can actually calculate the correlation. And so in this case, because you're not adding a new asset, you are just combining two portfolios with exactly the same number of asset, just a different proportion of it. Your correlation is all like this, just 1. So you just ignore any covariance here. All right. So now, with that in mind, we have calculated the portfolio standard deviation of 7.46 as given here. Okay, as given here. And what we can do is using the utility function. I hope we all recall the utility formula. We can calculate what is the utility of the portfolio given the risk aversion factor of 3. And we find that it's 5.17. Now, this is combining two corner portfolio, right? What if I'm combining a corner portfolio and a risk-free asset? Recall, this is not impossible. Remember what we can do because we are doing mean variance optimization. So I'm going to pull attention back to the modern portfolio theory. This I should do properly. Like this. Remember our curve like this, and then we can add risk-free asset given given by like this, and then we can find what is the intersection, let's say at this point here, right, where the risk-free cuts the mean variance frontier. So in this case, I want to do a calculation based on the intersection point between our risk-free and our portfolio, right? Our corner portfolios. So this is a second option. So instead of combining two portfolios, I want to do risk-free plus a portfolio. And how can we do this, right? So we first choose a portfolio with the closest highest Sharpe ratio that we require. And in this case, we choose portfolio 5. What does this mean? So recall we require a return of 6%. And given the required return of 6%, okay, we go back to our portfolio selection. So what can we choose? Around 6%. So we need to at least choose portfolio 5, right? Because we can't choose portfolio 6. 6 is very 5%. So we can choose portfolio 5, which gives us 6.47%, which is fine. Then we add some risk-free asset to reduce the expected return, but it helps you reduce the risk as well, right? So that's our objective now. So instead of choosing two portfolio, we choose one portfolio with additional risk-free asset. As we calculated in last lecture, risk-free asset reduces our standard deviation, which gives us the total risk. Right? So we calculate again the weight, which the same method. Y, this time we use Y instead of W. So we calculate the weight. We find that we require a portfolio weight of 89% or 0.89 for our portfolio 5. And our risk-free is 1 minus Y, which we have 11% here. Now, because we are only using one portfolio, we just multiply the 0.89 to all the weights in portfolio 5, the weights of the asset in portfolio 5. Okay. So we're not done with the question yet. So once we calculate what is our weights, we need to again do the standard deviation of this new portfolio. So the standard deviation of this new portfolio with portfolio 5 and a risk-free asset, because risk-free asset has 0, right? 0 risk. So we just take 0.89 times the standard deviation, which gives us this, which is a similar example in our lecture 2. And we can calculate the utility of portfolio B, the second portfolio, right? And gives us a utility of this using the utility function covered in lecture 2. Now, since the expected utility, so let's compare utility for portfolio B. The utility is 5.2%. What was the utility in portfolio A? Is 5.17%. So comparing portfolio A and portfolio B, we should take portfolio B with the risk-free asset, right? Because we can still achieve our expected returns of 6 point something percent. What's required? Let me just have a look. Of 6%, sorry. We just require 6%. So we can achieve our expected return of 6%. However, with lesser risk, because we are taking risk-free asset and we calculated that the utility based on the standard deviation of portfolio with the risk-free asset is much lesser. All right. So now, having chosen our portfolio to invest in, we're not done yet, right? Because the question is how much real estate investment can we buy, right? So we need to first of all know that we have a cash outflow from the gift of 150K and in 6 months, right? So we PV our gift for 6 months, that's why it's 0.5 here. Recommended, so based on, so we have chosen portfolio B as the portfolio we want to invest in, all right? Now, based on portfolio B, let's see what is the asset allocation for real estate. Because we're interested in investing in real estate, our asset allocation is 23.7% in real estate. Okay, you should invest 23.7%. Now, the thing is, we have this amount of money, right? And then we are going to make a gift. So of course, this money is gone. So we remove this. So our recommended allocation of is 23.7% multiplied by whatever cash that we have left after making the gifts, which gives us this 616K, around 616K or 616,550. Now, we know that we already have a house of 240K. So what is our remaining amount that we can invest in real estate asset class? Is just this minus this. This is our final answer here. Any questions for this example that we have in this lecture? This is an important example. Anyone needs me to repeat certain part of the solution or needs any clarification? We're all good. I know it's a Friday night. The weekend is here soon. Okay, I'll move on. I hope everyone's good with this. Now, would you repeat? Okay, which part? If you want, if you like me repeat, which part would you like me to repeat? Oh, or okay, if you need to repeat, or maybe you can watch the recording. Because this question is quite long. Is there any specific part that you're not sure of? I'm happy to repeat. If it's all, maybe you can read through a recording because that one you can keep on repeating. And you can pause it as well. That's the best part. Or unless there are more, are there others that require me to repeat the whole question? If there are more people, then maybe it make more sense so that okay, I think maybe it's maybe I'll suggest that you have a look at the recording because I think no one else wants to repeat everything. Um, okay. So maybe I encourage you to look through the recording. If you have any issues, drop me an email, and then I can explain to you. Because I think everyone seems fine with the explanation. For the interest of time, so that we can cover what we talked about. Um, Okay, right? So maybe just to highlight, like you say, in the important stuff, right? So maybe just to highlight. So the idea of this question, that's high level, right? The idea of this question is, okay, we are given two options, right? So the idea is what we want to invest in real estate. Now the question is how much we invest, given the whole situation that we talked about earlier. And the thing is, we have two options. Can we either combine two portfolio to get an optimized portfolio, or we combine a portfolio and a risk-free asset to get an optimized portfolio as well. So we have two kind of portfolio. Now we have done all the calculations and explained that. And the thing is, we calculate the utility of the portfolio. And we found out that the utility of the portfolio is higher for the portfolio with the risk-free asset inside, right? And after doing that, okay, then we determine, given the higher utility in a portfolio with the risk-free asset, let's choose the one with the risk-free asset, right? It's better, right? So we have done that, and then we determine what is the asset allocation to real estate, because our focus is real estate. And so we determine that the asset allocation for the portfolio with the risk-free asset in real estate is 23.7%, and therefore we calculate what is the remaining amount he can invest in real estate, considering his unique factors, right? Unique factors given PV of give, things like the PV of the give that he wants to give in 0.5 months, 0.5 years or 6 months time. Okay. And also that he has a existing real estate of 240K already. Okay. So that's just a broad overview of the important parts of this question. So if you do have any issues, I encourage you to look through the recording again. Now, for tactical asset allocation, so we earlier talked about what's the difference between tactical and strategic. So tactical, in this case, again, I'll not repeat, but it's just more of capitalizing on changes in the market, right? So do we need to shift our portfolio slightly to more in bonds, as we can see now in the market, or should we shift it more in stocks based on certain market conditions? So it can be bonds and stocks, it can be different geography. Maybe we want to avoid China because we know that if you look at the market conditions in China, it's not too good, simply because of some government political policies and things like that. You see a lot of stocks actually dropping in value in China. So maybe we want to avoid China in general, right? So we can have certain this kind of like situation-driven type of tactical asset allocation. Now, in terms of business cycle, we can see that there are two. So there's economic cycle and the stock market cycle. So we see that generally the economic cycle goes first and the stock market cycle kind of follow behind, right? So this is the economic cycle here, right? All these are economic cycle. I guess where we are might be somewhere here, right? Somewhere around here, this area. So we are in the middle bull or late bull already, right? So depending on your market expectation, you can say maybe middle bull, late bull, depending on where we are. And at this area, we see things like capital goods. We see things like what is increasing. Number 6, basic industry. Can even see some things like technology that's increasing, right? So these are some like things that we can consider. And if you look at the stock market now, actually technology is really increasing like crazy, especially AI stocks. If you're following the market, AI chip producer, things like users of AI or producer AI like Meta and all are doing very well. Amazon, chip producers are also doing very well. So we are generally around this stage here now. Okay, so we expect a peak relatively soon. . 。 So basic, I think there is a question, what is basic industry? So basic industry generally are things like pre, manufacturing stuff, right? Manufacturing, that basic kind of utility, so manufacturing of soap, uh, um, detergent, cotton, cotton products, this kind of like basic kind of stuff. Yeah, so that's more basic industries. Risk-based kind of asset allocation. Um, so you diversify your asset allocation based on the various risk factor. So things like equity is the highest risk. So maybe you have less of that. Credit risk, real estate generally helps to hedge against inflation. Maybe you want to have some of your investment in gold, um, and then maybe you have some portion of your portfolio in more active kind of management, which is quite common nowadays. You have semi-active, where is proportion is in more like passive investment, and then a proportion is active investment. This amount that's in active investment generally is to seek the alpha, or they call it smart beta, right? Or equity beta. So we have various kind of risk base. You can diversify across asset allocation, diversify against different market regimes, scenario. So basically, many ways to kind of reduce your risk. These are some small comments where diversification kind of fail. As mentioned previously, whenever there is a global event, like such as a recession, generally most instruments kind of converges, right? The risk profile converges. Even though your bonds, your stock, everything will drop, right? So there's a general convergence in a risky situation, and the correlation increase as well. I see a question here. What is beta? So this is covered actually in lecture 2A. Hopefully you have watched it. So beta is this, right? Beta is this. Beta. So beta measures your systematic risk of your asset. So it is relative to the market. So a market beta is one. Your risk-free is zero. And your stock beta, if it's more than one, means it's more risky compared to a market. Less risk, if it's less than one, it's less risky compared to a market, right? So that's how we understand beta. That's a good question. Alpha. So alpha is this, right? So alpha is basically any kind of return that is abnormal. Abnormal meaning that it's not your market return, it is above market return. So that return that's above the market, that's your alpha. That's a good question. In case, yeah, there are others that do not know what's alpha and beta. Last but not least, I just want to highlight this part, that liability risk, as we mentioned earlier about the mortgage example, you can only hedge your away your liability risk by, let's say, buying bonds, but you cannot reduce so-called or diversify your risk, right? You can only hedge. These are some small comments for you to read. Nothing too, I would say, important. Just the idea is that we need to make sure that we consider things like the economy, the kind of market, the government, political situation. Basically, you need to consider everything, right? That's happening in the market when we do your asset allocation. Not just, oh, I want bonds, I want stocks, right? We need to consider the whole situation in the prevailing market, as well as what we expect the situation to be in, let's say, 5 to 10 years, depending on our investment horizon. Uh, Another slide with a bit more comment, kind of commentary type of explanation is that we need to be disciplined as a portfolio manager, where if our IPS say that we need to maintain XXX percentage in stock, we should follow our IPS, right? We need to be disciplined. And in case our stock price, remember that asset allocation is a dynamic process. What does this mean? It means that, let's say, right, we have a pie here. Let's just say stock and bonds. This is all in stocks, right? These are stocks. Now, let's say the stock price has increased dramatically. So now the stock price, right, is here. And because the stock price has increased, now what happens? Our bonds, the proportion of stock is so much more than our bonds. So what does being disciplined mean? Discipline means that as a portfolio manager, we need to rebalance our portfolio now, right? So reduce the amount in stocks so that we maintain our strategic asset allocation. So this is what about being disciplined, right? So we need to ensure that we follow IPS. Also, at the same time, if certain assets are not doing well, we need to cut the losses. We cannot be, keep on hoping that it will improve, right? There's no point to keep on waiting, because at the end of the day, we are managing the money for our clients. And if the portfolio is doing badly, the client might just fire you, right? Fire us, because you're not doing a good job as a portfolio manager. At this point, again, I would like to highlight, various cognitive errors, things like loss aversion, things like various kind of biases that we have actually as humans. So we need to just be very cognizant about it. The main one that I like to highlight is this thing called loss aversion, meaning that the feeling of loss is more painful than the rewards of a gain, which is why an investor tend not to sell asset that's losing value, even though fundamentally the asset has tolerated, right? So maybe certain things are no longer important for people, right? So some analysts, I'm just going to use an example, do not quote me on this, but some analysts, if you read some reports, say that things like, the Tesla stock, okay, let's not talk about Tesla. There's a bit controversy. Let's talk about Paramount. So Paramount, the movie company, Paramount. Yeah, the one that sometimes you watch movie, you see that Paramount and all. So they so it's a stock exchange. Yeah. So if you are following Paramount stock, you notice that the value of Paramount stock has been dropping year over year, right? Not dramatically, however, it has been losing value. And a lot of the reasons behind it is that fundamentally the company is not doing well in terms of its strategic direction, in terms of the films that they are releasing. They are not doing very, very well in general. And so if we know that, if let's say we hold Paramount stocks and it's losing value year over year, and if we do a deep dive and realize, okay, maybe fundamentally their company itself, the CEO is not doing well, he's not leading the company well, then instead of holding the stocks even longer, we should sell it, right? So this is where loss aversion, because sometimes we will hold a lot of stocks in this, we don't want to sell. Okay, so we have various cognitive bias, behavioral bias. I'll not go through every bit of it here. I encourage you to just Google them. Most of them are quite self-explanatory. Once you Google, you can see the full list that's available. So in terms of asset allocation, the rule or the strategy is to think clearly, make sure you are careful about your bias, right? Make sure that you know that, let's say, if you are a techie, you love tech, you love big data, AI, do not be biased by saying you want to buy into AI because you love the company. Think carefully, right? Make sure you make an informed decision. Why are you buying into AI products or stocks in general? Understand how trends influence your portfolio, able to meet your client's funding needs. Recall that funding needs does not equals to more return is better. It could be maybe stable cash flow and the need to make necessary kind of adjustments, right? So this is just a checklist. I'm not going to go through. Uh, there's this last part that I'd like to consider here. I do see a question. How do you check whether the company is not doing well? Okay, so how do you check I believe you're asking about the fundamentals, right? How do you check the fundamentals? So to check the fundamentals, basically you need to do fundamental analysis. So if you have taken the 355 equity valuation course, that is basically fundamental analysis, right? You do the whole deep dive into a company's financial ratio. You talk about PESTA analysis. You think about the market environment. You look at the board of directors. That is fundamental analysis. So that's how you really know the company is doing well or not, right? Based on strategies and like what it's doing. Okay, so last component on asset allocation that we want to cover is human capital considerations. So human capital is basically the present value of our future income, as you can see here. Um, you know, often if you are young, you have the highest human capital. If you are older, less human capital, because less time to earn money. Um, So if you have more human capital, you can invest more in equities. If you're a bit older, maybe you should invest a bit more in, let's say, bonds, less risky products. Um, and based on your human capital, you should adjust your portfolio accordingly. Okay, so this is a graph to show you the trend of human capital versus financial capital. So financial capital increase over time as you have more savings. However, your human capital decrease over time. Yes, that's a good question. Yes, you can look at various analyses in the market as well. And usually these include like broker reports, kind of analysts recommendation, comments on various companies, right? Of course, at the end of the day, it's best to do your own analysis, right? Do not trust fully a analyst report. Now, for human, so for this, there we have an example here. So William has a targeted asset allocation of 60/40. So he's using the experience-based approach. His financial and human capital in constant dollar terms at various ages are this. So this is financial. So how much he has in his bank. This is his human capital, right? How much he can earn based on the present value of his future income, future salary in that sense. So assume that the human capital is approximately risk-free, so no risk for human capital. Determine Smith's or William Smith's asset allocation in stocks, bonds at different ages. Okay, so we know that his targeted asset allocation is 60/40 based on the experience-based approach. So we see that at all age, his wealth is 2.2 million, right? Human capital plus financial capital combined at all ages is 2.2. Now, so given his optimal strategic asset allocation of 60/40, we find that his optimal bond allocation is this amount. Now, let's look at, stock is 60%. So let's look at what he can do. Now, at age 30 and age 50, he has not enough financial capital, right? This 60% is around 1.35 million, right? He wants to invest 1.35 million in stocks, but he at 30 years old, 50 years old, he cannot do that. So unfortunately, he cannot. However, at 65, he will have enough money already to invest in his targeted asset allocation. So this is what is explained here. So at age 30 to 50, he had to invest everything into his stock. But even investing everything, he has not meet his targeted asset allocation of 60% in stocks, right? He has only met 40%, or at 30, he's only have 4.5%. Now at age 65, he can achieve his allocation in stocks and bonds accordingly. Any questions so far on human capital? Human capital is salary. Basically, the most base form is salary. Okay, so at this point, let's take a break. I'm going to cover a portion of this, which is actually next lecture's material, but just a small portion. But let's take another 7 minutes break. We come back at 8, sorry, 9:15, right? Let's come back at 9:15. And then we'll cover the first portion on formulating market expectations. Hello, welcome back. Let's continue our last part of today's lecture. I do see a question regarding the first part of the lecture. Yeah, I'll see what I can do. Either I'll re-record the first part of lecture today. If not, if there is a past recording that I've done for um, when I taught the module, and I'll look through that recording if it's still relevant. I'll upload that portion of it, right? So it depends. I'll review it. I'll check whether um, either I re-record it or I'll upload the portion of the last term that I taught, right? So I'll just make sure. I'll make sure that if I upload last term one, I'll make sure that the content is still relevant. So I'll have a check on that. Yeah, no problem. Yeah, apologies that I forgot to record the lecture. Next, maybe the next lecture, if I do forget again, do not hesitate to kind of ping me and let me know. Um, Regarding, I do see a question, so maybe it was a more private message, but in case you are joining as a guest, which I see quite a few of you are joining as a guest, do not worry. The attendance is taken. As you know that for this module, given is a PM class, the class participation is purely based on participating in class, meaning that your attendance is not part of your class participation marks. So at the start of module, I usually like to make it very clear, right? So you know how you're going to score. So the idea is that for class participation, um, everyone gets 50% of the marks. The other 50% is purely on how active you participate in class, right? So for those that really want to strive to get the full, if you participate actively, you can be rest assured you will get the 100% of that portion of your assessment, right? So yeah, usually I like to make it very clear. So those that want to really get the 100%, you know what to do. Okay, so let's continue on the last part of today's lecture on formulating capital market expectation. So we'll cover more because as this is for the next lecture, this lecture it's more like an overview of what we have talked about in your year one, right? So how do we formulate market expectation based on some quantitative aspect of things? So the qualitative actually is my opinion, more important. The qualitative we will cover in our next lecture. And that aspect really requires kind of deep dive into things like inflation, things like what is our monetary policy, what's our fiscal policy of the central bank, etc. So that we'll cover in the next lecture. Now, in this lecture, the overview or the idea is that can we form some market expectation based on some quantitative tools that we use, right? For example, things like calculating, the bond yield and things like that. So we have a look at this. Okay. So what is capital market expectation? The idea is that we want to formulate how the market is performing in the future. And expectation means the future, so that we can determine what to invest in, right? That's the idea of it. So what is the market condition in the future so that we can invest in certain things that would capitalize on the positive market trends. So essentially, by formulating market capital expectation, we can determine things like what is the strategic asset allocation, whether you should do long, short, kind of term. Are we doing things like developing certain asset allocation based on things like beta and maybe not alpha? And we just now was a good question. Someone was asking as well, what is beta, what's alpha? So we can't very explain that. And yeah, that's the market expectations framework. So some frameworks we can either look at historical, but historical there's an issue of also what in history will history ever repeat itself, right? That's the question in the market. Yes, it might be similar, but will it ever be the same? That's the problem. They need to be very careful on. Set some expectation, time horizon, of course, interpret the current investment environment. This is very important. And this is, of course, more qualitative, right? not very so quantitative. We can get into quantitative aspect of it, but it's generally more qualitative. Um, Monitor actual outcomes and expectation and how it's improved. Can we predict the market? That's a good question. I guess if we have a crystal ball, we can. Crystal ball meaning that the ones that those fortune teller has, then we can predict the market. Yeah, that's a good question. If we can, it'll be I think you can be like millionaires. And that's what people actually try to do, right? Their whole career is about predicting the market. That's where you have your chief economies, chief investment strategies, right? So that these kind of roles are generally roles that the aim of it is to predict the market so that they can advise brokers, they can advise traders what to do, right? So if you're if you were very interested in things like market conditions, fiscal policy, how does interest rate affect our stock market, how does inflation, what does inflation means in terms of the market conditions, things like that. If you're interested in it, you can consider jobs like a strategies, economies kind of jobs. Those are quite quite good jobs as well. What's the budget? Yeah, even the budget. So like, what's the government budget? What is the government plan? Are they going to change the, of course, this year we know that the GST has hiked. So what does this mean for consumers? But more importantly, if you are a strategist or economist, what does it mean for the economy, right? Yeah, okay, so the GST hike for individual, we pay more GST, but does it actually impact the stock market? Is the stock market reacting well to it, right? So, these kind of things we need to consider, right? What's the government budget as well? Okay, so going back to this expectations, the problem with formulating expectation is that sometimes data, especially forward-looking data, can be very difficult to get, right? We have a lot of historical data, but we know that the idea is the history does not necessarily repeat itself. So it might be tough to ensure that the data continues to be relevant. Okay, we have a question. Which part of which part? Now, so this question is kind of a loaded question, right? So usually the first thing I will ask you is, okay, affect the market. So what market are you talking about? Are you talking about the market of stocks, or is it bonds, or are you talking about derivative market? And when you talk about derivative market, you open the whole almost like Pandora box, right? Are we thinking about credits, right? Are we trading on credits? Are we trading on put options? Um, put and what's that one? Put uh, or even options in general, right? So it opens the whole conversation or call options. Thank you. Yeah. Put is to sell later and then call is to buy. Yeah. So put and call options. Yeah. Right. So you open the whole bucket of things. Or are we talking about like real estate or things like sector as well? So I think we need to be very careful when we talk about predicting the market and like what affects the market and what is the market we're talking about, right? What actually affects it. So we need to be careful on that. There might be some data measurement issues. Generally nowadays, data issues are minimal. Most issues are based on either personal bias or your own data model issues, right? In terms of the data itself, usually the data is quite robust. Limitations of any historical estimates, some bias, misinterpretation. So a lot of misinterpretation is usually the issue. Again, we talk about when setting market expectations, similar to when doing strategic asset allocation. One of the key issue we have is psychological traits. Okay, so again, I want to highlight that this I encourage you to just do a quick Google, right? If you don't understand what it means, just do a quick Google. What is anchoring? What is status quo? And usually the explanation is just a one line kind of explanation. And once you look at it, you can't understand. So it's very direct. That's why I'm not going to repeat. Now we have a question here. identify the psychological traps in inferring when creating the following forecast, right? So this is the question, and we are given this. So when we look at any case, right, we should always comment on psychological traps. So this includes, your GBA, includes, your finals, any kind of assessment where it provide a case. I want to encourage you to look at psychological traps because remember, at the end of the day, this course is to teach you how to be a good portfolio manager, right? How do you do portfolio management? And so when one of the key things is that because portfolio management is about interacting with clients, we need to identify their psychological traps so that we can advise them accordingly to avoid falling into those traps, right? So let's have an example here, right? So Seth is an analyst who's preparing a forecast regarding the current capital market environment, right? He's recently given a presentation to the managing director of the firm. Excerpt of his presentation follows. Now, noting that the year-end holiday sales has been weak over the past several years, I believe that current market condition should be likewise muted. Okay, what's the psychological trap here? Anyone knows? It's like recency bias, right? Or recallability, right? Meaning what? Because something happens recently, does not mean that it should continue to follow, right? So because it's something new to you, very recently, the news is recent to you, this is a recency bias or like a recallability kind of bias, right? So that's something you can point out. In fact, just last week, I had an occasion to visit Harrods and noticed that the number of shoppers seems low. The last time I saw a retail establishment with so little pedestrian traffic in the beginning of December was 1990. So now the second part, can you see that he's using historical data to validate his current expectation? So remember we talked about how the history does not mean that history will repeat itself, right? Does not mean that it will continue to be low, right? So that's another bias. He's basically trying to validate his expectations based on something that might not even hold true. And it coincide with one of the worst holiday sale period in the past 50 years. Thus, there is no overall year-to-year sales growth this holiday season. So if we just look at what we see here, right, we can tell that there is definitely some status quo bias. Status quo meaning that, remember the December one? There's a bit of anchoring as well, in the sense of we anchor our expectations. So anchoring is like you you use a reference point to say that, okay, because of this reference point, everything else should follow this reference point. You're anchoring your expectation. So there's some anchoring that you can see. Maybe there's even confirmation bias or confirming evidence. Just same the same kind of bias but different terms. Confirmation bias meaning that you try to find scenarios to confirm your expectation, right? But by cherry picking these kind of scenarios, it does not mean it's true, right? Yeah, because you're just picking the scenarios that suits your requirement, right? So these are some psychological traits. Overconfidence, not really. Maybe you can say a bit of overconfidence because he said there will be no overall year-on-year sales this holiday season. So he seems very confident, right? Maybe you can say it's overconfident, maybe. Prudence, not really. Recallability, we did mention at the start that there is a bit of recallability bias here. Any questions for this? Okay, so for tools for formulating capital market expectation, like what I mentioned, we focus a lot on quantitative tools today. So we have statistical methods. So we have the sample estimator, meaning we basically um, use either some data points in the past to estimate what happens in the future, right? So things can be like what's the arithmetic mean, geometric mean. We look at the mean variance framework, expected return, standard deviation, correlation, variance. So these kind of things, like whatever that we have been talking about, right? These are like statistical kind of historical data that we use to try to predict the future. So shrinkage estimator, basically you do a step forward. Use the historical estimator plus some other estimator, right? That reflects like belief. So for example, okay, you expect maybe inflation to be 5%. Okay, that's what is that's the let's say that is based on the CPI index, right? In the government that is being released by the statistical department from the government, right? 5%. Now you have to add some belief inside. You say that okay, 5%, yeah, maybe it's 5%, but you think that it might decrease to 4%, right? So you say that maybe it's 4.5%, right? So you add some belief. So this is like a shrinkage estimator. So you reduce some extreme values. Um, Time series estimator. So what this means is that we have a variable that is changing with time. Okay, so it's quite a bit of explanation here, but let me just try to explain it in simple terms, right? So we have a variable meaning x, y, z, we have an x, let's say, that is being let meaning what? Instead of x t, we have x t minus 1. So what does this mean? So let's just put it in context here. Okay, so let's say we have our investment is relate, it is proportional. Let's say it's proportional or is related to interest rates. However, it's related. We notice that this investment product, let's say a type of bonds, is related to the interest rate in the previous month. Previous month, meaning is lagging. So the current price of this investment is related to the previous month's interest rate. So it's not the current interest rate. If we have such a product, then we need to use a lagging estimator. So X becomes the interest rate in T minus 1. So it's the previous month's interest rate instead of current month interest rate here. Okay, so the idea of whenever we do time series estimation, we need to consider things that are lagging but should be included as well. Anyone can kind of highlight or know any other lagging indicators that should be used in a time series estimation? Okay, so other kind of estimator that we can think about could be things like labor force, right? Labor force or employment percentage, right? Employment percentage would kind of impact, in terms of a lagging form, the returns on the company, right? So if the unemployment rate is high, it means that likely the unemployment rate in the previous month would impact the current month productivity of the company, right? So we can kind of draw that relation where it impacts in a lagging basis. I see a question, why squared? Now, square because it's volatility, right? Volatility is measured by variance, which is SB square, standard deviation square. So in other words, what it means that when you have a lagging indicator, it means that this indicator, so they use beta here, it can be X, which I, in my example, right, remembers the past period because you are including some memory of what's happening in the past, right? Remember we talk about the interest rate, we are remembering the interest rate of the past. That's why it's being brought into the current day situation, right? So there's a bit of memory, if you like to put it in an interesting way. Okay. Other statistical methods, we have the multi-factor model where you can have basically many variables or factors, right, affecting the model. However, the more factors you include, you must do a variance covariance matrix to make sure you consider any correlation based on the model, right? Based on the variables that you have added into the model, whether there are some correlation between those variables. Okay, so we have another other uh, model, not new, I hope, to everybody. This is the DCF, discounted cash flow. It's covered in year one. So in the most traditional form, we do have this thing called the Gordon growth model or Gordon or constant growth model. So this is to value stocks using the dividends. So D1 is the annual dividends divided by P1, which is the current price of the stock. Sorry, D1 is the next year's annual dividends. This is important, it's next year, right? Then plus G, right? So this is the Gordon growth model covered in year one. G, which is the long-term growth of the company, is based on the GDP and plus any corporate excess growth. So we have another model called the Green Corner model or GK model. So this model is the Gordon growth model. However, we add a few more things here. We add this and this, right? So what are these? What's these three things? So we added the expected change in number of shares. We added inflation inside, and we added the change in P. So we have an example in a bit to explain this model as well. Okay, so this is the example here, right? So we have the following information pertaining to the Australian investment market and the economy. So the information is divided into three parts. We have the 10-year historical, we have the current, and we have the market expectation. So we have three different types of information. And some of them are repeated, right? For example, for current, we have the current 10-year bond yield, government bond yield, and then we have 10 years historical government bond yield. Okay, so we have different type of information here. Now, the question is, calculate the expected, okay, Australian equity premium using the GK model. Okay, now, given the question expected means that we should be using the values under the expectation, capital market expectation, and the current, right? We shouldn't use the historical in this case. Okay, so let's see how we calculate it. So in the GK model, we need the change in number of shares. We need a change in PE. Okay, so let's look at the change in number of shares. Let's see. They don't mention any change in number of shares, so it's 0. Okay, so change in S is 0. Now change in PE, we see that there's a change in PE here. 4.5 to 14.5 to 14. So we can calculate that. regarding the change in PE. Just give me a moment. Let me just charge. So, okay. Then we are given that inflation, expected inflation is 3.5. Expected inflation 3.5. So we can add that inside. And so let's see. We have the expected annual income of 1.5, expected growth of 5%, right? So we have 3.5, we have 5% expected growth, 1.5, and then we can calculate what is the change in PE, which is given here, negative 3.45. And this is what is our expectation. Now, the question is, what is the equity risk premium, right? So remember, equity risk premium is what is above the risk-free rate. So what's our risk-free rate here? Our risk-free rate is based on our 10-year government bond of 5.6. And so we just take 6.6 minus 5.6. So the equity risk premium that we are charging for holding equities is 1%. Questions? Okay, no questions. RE, ERE, this is the expected return on equity. Expected return on equity given by this formula, right? This one here. So ERE is expected return on equity. Now, that is the equity component. Let's look at the bond component, right? So bond pricing, we are going to fall back on our most traditional form of bond pricing using the annuity. So this is the annuity formula. This is, I hope you remember, in year one, you learned in 203 on bond pricing using ordinary annuity. So we just need to make sure that we add the par value back at the end, right? So I'll not repeat this again. If you need a recap on bond pricing, I encourage you to refer back to your 203 content. Okay. Now, the issue with using the ordinary annuity as our bond pricing is that we assume that the interest and coupon are being reinvested at the rate of yield to maturity. And in this case, more of the time, it's very tough to reinvest at such a high rate because your yield to maturity can be, let's say, like 10%, right? So you're saying that every time you get interest or coupon, you're reinvesting at 10%. However, given maybe the market conditions and all, you might not actually be able to invest at 10%. So this is a big assumption. Usually it does not hold true, meaning that our expected return based on this easy calculation of ordinary annuity for bond pricing is not very accurate. So if you have a zero coupon bond, that would be the best estimator for the yield to maturity of a fixed income instrument because you avoid the issue of yield to maturity. All right. The yield to maturity in simple terms is basically the effective interest rate of the bond. Effective interest rate, meaning that if the interest is of all your inflows is treated as 1 year, in just 1 year, what is the effective rate, right? That's your yield to maturity. So in case you need some revision on this bond pricing component, I encourage you to review your 203. I believe your tutor at 203 should have went through in very, very much detail, right? Because this is more advanced class, so we don't want to go through again what is covered there. So what we are going to focus on is this idea of using the bond yield to maturity to calculate the equity return. So we use a risk premium approach. So what does this mean? It means that we know equity is more risky than bonds, right? Bonds are less risky. So if we have the base of it is as a bond, we just add the equity risk premium, and then we get the expected return on equity, right? So we use the bonds yield to maturity. And usually in this case, we use 10 to 20 years bond. And I guess as you do more of your case study, you'll start to find out, okay, should I use 10 or 20 years? So I would say whenever you want to decide 10 or 20 years, look at your investment time horizon, right? So if your investment time horizon is 20 years, choose a 20-year bond. If it's 10 years, choose a 10-year bond. If it's a 15 years, choose a 15 years bond, right? So whether, yes, use long-term, but I guess the question is, how long should you use? So look at investment time horizon. That's my advice, right? So in this case, I think we have a question here. So this is just an overview, nothing to think about. Okay, we have the same question here. Australian market, calculate the historical Australian market risk premium using the bond yield plus risk premium approach. So that's what we just talked about, bond yield plus risk approach. Okay, so what do we do now? We are looking at historical. So we only look at these two columns. These two columns, current and historical. They're not considering this anymore. Bond yield plus risk premium approach. So we can see that 10 years government bond is 6.6%. Equity return of this. Okay, let's just see. So the historical equity risk premium, we can see here that your annual equity rate return is this, 7.3. Your bond is this. So what is the premium above your bond? You just take 7.3 minus 6.6. So in terms of risk premium approach for fixed income, now we are focused on fixed income here. I have a question. 6.6 is yes, 6.6 is the 10-year government bond yield, historical in this sense. Yes, is the risk-free, considered risk-free. So the risk premium approach, now, this risk premium approach, what's the idea of it? Let's think about idea. There's so many things here, right? The idea is that we want to have a risk-free. We start with risk-free, okay? For me, it's like a pizza. And then you add in all your ingredients, add in the sauce, you add in the cheese, your pepperoni, your veggie, everything. Keep adding in stuff. It's like a pizza, you add stuff inside, right? So the risk-free is like your dough of the pizza, and then everything else you keep on adding is all your small little components here, right? That makes up your whole pizza. That's how I like to think about it. These components, I wanted to highlight, it changes over time. It can change. You need not have all the components inside, or you can have all the components inside, right? So it really depends on what your requirement is. So this is as an example of having a lot of ingredients in your pizza or a lot of components. For example, inflation, you want to include inflation, you want to consider things like default risk, how likely your company is going to default and not pay. Illiquidity risk, you want to consider, okay, can I actually sell my bonds? Is it easy to sell? You want to consider things like interest rate. Is it easy to is it affected by the duration? Remember just now we talked about duration and convexity. Is it affected by the duration and convexity? And how much is it affected, right? Interest rate risk. Tax. Is there any tax advantage in holding bonds compared to stocks? In Singapore, generally very easy. However, a lot of the case that you might tackle is not in Singapore, right? So we need to consider tax implications as well. Maturity risk premium, of course, the longer the bonds, the higher risk of default, you should be rewarded more in a normal case, right? That's why I did the case on the inverse yield curve, which might not be the might not give you a higher return for a longer bond nowadays, right? So we need to consider things like this in our formulation of market capital expectations. Okay. So we have one more tool, which is the black determinant approach. To formulate basically just the reverse engineer is already covered earlier, so we'll not go through it again. This is in your year one. I hope you still remember to calculate expected returns using your CAPM model. So hope this is not new to everybody. So this is your CAPM. Just now there's a question on what is beta? Beta measures systematic risk, right? So this is in your year one. The formula to calculate beta is this, right? So remember, beta is always relative to the market, right? So how much more risk compared to the market? So it is the covariance of the asset RI and the market, right? Remember, covariance is the variance, meaning how the movement of the two, right? What is the variance between the two? Divided by the variance of the market, right? Because it's relative to the market. So you always divide by the market. That is your beta. And your beta for the market is 0. Okay, so at this point, I'll stop here for today's lecture. We'll cover this approach in the next lecture. Okay, I'll pause here. Any questions regarding today's lecture? Any feedback that you'd like to give? We'd like to go through certain things, maybe in the next lecture. CAPM. That's a good question. What does CAPM stand for? Capital allocation something model. Yeah. I can check for you. I can check what CAPM stand for. But CAPM basically is this capital pricing. Yeah, yes. Capital, yeah, pricing model. Thanks. Any other questions that we have? So quick reminder for you to submit your TMA if you've not done so. Hopefully you have done it. I'm wondering, are you in year one or something? Are you in year one? Is this like your first finance module? Because it's quite surprising because like CAPM and like things like beta and all should be covered in the 203 module. Yes, you can use Excel and calculator. However, for your finals, what I understand, it might change, but what I understand it is a closed book. There is formula sheet given, but it's closed book. So yeah, just take note of that. Yeah. I think if you study for finals, it's not so bad, but it is last terms I think is close book. Any other questions? Let's see. Close book theory. Yeah, I think nowadays most modules open book. Uh, but yeah, but then now I think I don't know why it's closed book for this. However, this term might change, but what I understand as of now is closed book. Whether the course leader wants to change it, they will announce it accordingly directly to you from the school uh, to you. Ah, okay, study financial market. Okay, okay, that's good that you like to study the financial market. Negotiate. My what I understand is usually they would set the questions in advance, meaning actually the questions are already set. So I think the course coordinator would know whether it's closed or open book, but then I think they need to decide itself. So I, of course, given that it's closed book, it's a bit tougher. I really encourage you to work on your GBA because your GBA is quite heavy. Your TMA record is only 15% of your overall. Your GBA is quite high. So I encourage you to work on the GBA to score as much, right? Then at least not so stressful for the finals. Okay, let me pause the recording.